This will cause a hard landing. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, it's Bank of America's dire warning on what will trigger the next financial crisis. I'm going to show you what it is and why it's coming sooner than most people think. And President Joe Biden made a rare comment about monetary policy. Is this celebration a bit premature? Well, stay tuned. Now let's head over to Bloomberg, where we picked today's story up. I want to take a look at what's going on in China because something big has happened as the consumer price index for China drop has further worsened and is now fueling deflation fears. And in a debt-based economy, one of the worst things that can happen is deflation. You'll hear central bankers talk about how they can manage inflation, how they have the tools to deal with it. But when it comes to deflation, well, that's the one thing that keeps them up at night. I'm going to show you why it's bad news and even worse for the world's largest exporter. Producer prices further declined 3% compared with a forecast of a mere 2.8% drop, as factory gate costs have been mired in deflation territory for 14 consecutive months. Now, for the rest of the world, you have to keep in mind, China exports deflation. And when you think about it, when you go to the store and you purchase something that is made in China, well, now all of a sudden you start to understand that if their producer prices are declining, and this is what's coming out of the factory, well, that means those are being transmitted into lower U.S. consumer prices. And with the Fed worrying that we're going to see a resurgence in inflation, well, what we can tell you is based on what's happening in China alone, the likely path to the consumer price index is actually much lower, not even higher at all. And here we can see the consumer price index in blue against the producer price index. This for economic activities and industrial activities total for China. Both showed on a year-over-year rate of change. And here you can see China producer prices lead the U.S. consumer price index down because not only they are the world's largest exporter, we're the world's largest importer. So that's why we export inflation in terms of dollars. They export deflation in terms of goods. And you can see that in every instance, a decline or slowdown in Chinese producer prices led to a corresponding slowdown in the U.S. consumer price index. You see that here during the global financial crisis. You can see heading into what was likely to be a globally synchronized recession in 2015, 2016. That too caused the U.S. consumer price index to head down. Heading into the pandemic, before it even happened, we were seeing another slowdown that corresponded to lower U.S. consumer prices, and now we're seeing it as well. And yet people still believe that consumer prices are likely to head higher, but China is telling us no, the world is starting to be gripped with deflation. This is bad news for debt-based economies all around the world. And in the short term, though, it's a big boost for central bankers if you want them to cut rates or even just pause where they're at now. Deflationary pressures have increased because of weak domestic demand, a case we've been making for a while, which highlights the importance of more supportive fiscal policy. So here you can see that the moment you get any talk of deflation in an economy, all of a sudden you'll immediately then turn around and hear central bankers talk about we need stimulus, whether it's monetary, fiscal, or both, because we cannot, under any condition, let deflation take over at all. Because deflation is dangerous for China and any major industrialized economy because it can lead to a downward spiral of economic activity. Consumers start holding off purchases on expectation prices keep falling, which further weighs on overall consumption. Businesses, in turn, might lower production and investment due to uncertain future demand. And next thing you know, you have a downward spiral that is very, very difficult to stop. If what we see in China starts to proliferate around the rest of the world, watch out below, because that means we're back into this mode of a globally synchronized recession. As we've made the case in the past, a financial crisis is likely, and we'll show you, of course, what Bank of America says is going to tip all of that off here in a bit. As deflation can also make monetary policies to stimulate the economy less effective, as declining prices lower corporate income and make it more difficult for companies to service their debt. So you think on top of all the issues we have an insolvent U.S. banking system, we have an insolvent Chinese banking system, we have massive debt levels, not only on the consumer side, but on the government side all over the world. So if you start getting deflation and a decline in demand, it means the ability to service these debts go away. Next thing you know, you have further insolvencies, you have delinquencies, you have defaults, and there goes what is already a banking system on the brink of an all-out global crisis. The central bank has sought to downplay the risk, of course, of deflation this year, with an advisor to the People's Bank of China saying last month that those pressures, well, they're only temporary. They're not temporary at all. They're a massive problem. And as we talked about yesterday, this is filtering into their stock market, threatening an all-out crash here. As Hong Kong stock slump triggers wave of brokerage closures now, we're seeing these companies are going out of business as 30 local brokerages have closed down this year after a record 49 shut up shop in 2022. This comes as Wall Street banks lay off deal makers due to a plunge in initial public offerings. The Hang Seng Index is headed for a fourth year of declines, the longest losing streak in the gauge's history, and even fell on a one-year low this week. And of course, when you start hearing things like that, you start thinking perhaps opportunity is indeed knocking here. But one thing that is interesting about this is that most U.S. investors believe that low inflation is the biggest boost for global equities, particularly U.S. equities, and when in fact, as inflation comes down, it's not good news for stocks at all, because it's telling us demand is falling. And when demand falls, well, that means corporate revenues come down, and earnings come down, and profits come down. And lo and behold, as you're about to see, stocks go with it. And here you can see the Consumer Price Index in blue on a year-over-year rate of change against the Wilshire 5000 Price Index in red. And sure enough, that initial pause and decline in inflation gives investors some excitement until they realize it's a demand issue in the economy. And you note stocks come down after that. You can see here again in the global financial crisis, stocks were already coming down ahead, but when inflation came crashing down, it wasn't a boost to stocks at all. In fact, even in 2015, 2016, that decline in inflation led to a sideways stock market. We see it again here in around 2019. And now investors really believe that inflation is going to smooth out, it's going to moderate, and next thing you know, it's going to cause a huge boost to stock prices. And that's just not how it works. But if you're trying to figure out how to get a better gauge on the market, how to buy low, let me show you. Because when you see this news, you see this talk about the Hang Seng Index, you might wonder, well, how do I trade it? Well, I'm going to show you exactly how simple it is. Here you can see a chart of the Chinese ETF. This one is the biggest one. And you can note the market's been coming down. You might say, gosh, Ben, what an opportunity. If I could have gone back to 2022 and had some sort of a signal, what a huge rally that could have been for my portfolio or my trading account. But look, let me show you how easy it is with our CTA Time Pro. We look at the machine positioning, but we run an historical overlay. This is from today's reports. This is what our subscribers see. They see this signal. Minus 100% short on the fast and the slow trading algorithms, and they say that is opportunity. What do they look for? A reversal in the signals. And those that have both reports, pair them together with our technical signals on our Momentum Timer Pro, we see 9 consecutive days of sell. We see on the 3-month window, momentum is dropped to a negative now. It's a sell signal. What are we looking for? A reversal in both. You pair those together, and it just makes trading that simple. You know, so many people say, can you be successful with your reports? Yes, you can. One trade can pay for a whole year of service. In fact, one of our subscribers said, a year? He says, it paid for a whole decade. One trade went so well. He says, I love this. And you too can be on these reports. Links in the description below. And I put 3 coupon codes for a free month. So this could be your opportunity to pay for all your research for a year. Find that trade, make some money, join the rest of us. But one person who's way behind on things is Bank of America's CEO, Brian Moynihan, says the economy is slowing, but he says, wait a minute, the outlook, well, it still looks positive. Well, Brian, we're going to put this to the test here, because you might think it looks good, but I'm going to tell you why. That it's just a matter of time now before the next leg of the economy moves down, and is coming probably very early next year. The reality is there's going to be a slowdown, but we just got to be positive. Moynihan said on Tuesday, money is coming out of customer accounts and consumer spending is leveled out. So that's good news that the economy is normalized. In fact, it's just that easy. We just need to be positive that the economy is going to level out. We'll have a soft landing. And sure enough, this must be all it will take. As Moynihan's remarks track with recent data points, U.S. consumers have been pulling back on spending. Well, that doesn't bode well for a soft landing, particularly for big ticket items as inflation continues to linger and borrowing costs stay elevated. The only question here, wait a minute, I thought you said that Bank of America mentioned that there's a trigger point. There is. I just want you to see the CEO at the helm of the big bank is saying, look, you just need to be positive. And if you are, then everything will work out just fine. That's the issue here. Because many economists are also see spending holding up long enough to avert a recession. But much of the outlook depends on the job market, which has been cooling in recent months. We've made the case of why it won't be too much longer before we continue to see an uptick in initial claims, because where continued claims go, initial claims follow. We're not seeing a big drop in continued claims, meaning people on unemployment are not finding work. That means their income is being cut, their discretionary spending is going down. But let's make the case, is retail sales going to continue to hold up? I'm going to tell you, I don't think so at all. So Brian, here's what I want to show you is total compensation. This is average hourly earnings of production and non-supervisor employees multiplied by average weekly hours. And what you have is total compensation against advanced retail sales. And when total compensation goes down, well, lo and behold, people spend less. And that's the trend we're seeing now, as we note that as of Friday's payroll report, indeed, we are seeing a trend lower in the production and non-supervisory employees. There's a little error here. I did pull the manufacturing for the weekly hours work. Wait till the end. I've got an updated version on this slide. We'll show you further decline here. So when people make less money, and I know, Brian, you know this because you see all the data. You run the bank. When people make less money, they spend less money. And the trend right now is fewer hours and lower amount of weekly pay increases. It's all slowing down. That means we're not going to see a soft landing at all. But yet he says the Federal Reserve is fighting inflation by raising interest rates. Quote, we've got to be careful we don't win it by too much right now. And he's right, because if we win it by too much, well, that means everything comes crumbling down. Let's take a look here, because, Brian, you're running one of the biggest banks in the country, and you know that you're tightening lending standards, and you know when you do that, you lend less because, well, that's what you're doing, and we can see that here in the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes here, and that includes Bank of America, and we can note that anytime that blue line's above the horizontal black line, well, that means banks are on net tightening standards on the way down. It still means they're tightening, just not as much or as many banks. And what eventually happens when you constrict the creation of money in a debt-based economy, lo and behold, you slow the pace of inflation, as you see here in the dot-com bubble, and then it comes crumbling down. You note that in the global financial crisis, it rose because of oil, and then it came crashing down, and now it's coming down, and everyone says, look, this is a soft landing. It's not. The longer you constrict the creation of credit in a debt-based economy, the worse it eventually gets. And we're not seeing any information out of the banks telling us that they've gone back to easing credit. We're not hearing it from consumers or businesses. They're saying, hey, you know what? All of a sudden, I can go get a loan that I couldn't get, a month ago or 6 months ago. We're not hearing that at all. In fact, what we're hearing is consumers are hitting the red line on their credit cards. We saw that in the consumer credit data. There's a broad slowdown in credit creation, and that means the next leg of the economy is not this hope to be positive that we're going to have a soft landing. Well, as B of A's leading economist says, well, I'll show you what the trigger point is for the hard landing. As B of A's Hartnett says, bond rally may drag on stocks in early 2024. Why is he talking about bonds? Well, because they price in growth and inflation expectations. And when bond prices go up, that means interest rates are going down. And when interest rates fall, it tells us inflation is going down. It tells us growth is going down. It tells us demand is going down. It tells us all the wrong things are happening. And the reason interest rates fall in a debt-based economy isn't just because people are buying them or central banks buy them time. It has nothing to do with that. It has to do with the credit creation mechanism. Rates start to fall because if they don't, asset prices come crumbling down. And the reason rates fall is to spur the creation of credit. So rates go down, you don't get credit creation, asset prices come down. And mix and repeat. Go back to every financial crisis we've had. That's the recipe. It happens over and over. And he says stock markets will suffer in the first quarter of 2024 as a rally in bonds would signal a sputtering economic growth. Well, he's got that right. A strategist who has remained bearish, even as the S&P 500 rallied about 19% this year, said lower yields were one of the main catalysts of equity gains in the current quarter. However, further drop toward 3% would mean a hard landing for the economy. So what is the shift here is because equity investors believe that lower interest rates are great. And at first they seem to be until they're not. And that's the problem, is they don't understand that lower interest rates mean the economy is indeed slowing down. We're heading to a recession. It's contracting. And let's take a look further what Hartnett had to say. Because he says the narrative, quote, lower yields equals higher stocks would flip to lower yields, lower stocks. And he's right. Let's take a look at the Wilshire 5000. Now, he notes the 3% line in the sand, which I drew that green line in, and there's no historical correlation to that because we've got the 10-year Treasury yield in red. So the question is, if the 3% thing is just his call, his line in the sand, what we do know is there is a decline in yields. Well, there's your decline in the stock market, decline in yields. There it is. You see that relationship happening repeatedly. Now, the question is, what was Hartnett really referring to? He's talking about the yield curve, and this is when you take the 10-year and you subtract the 2-year, and when it inverts, that's when it's under this horizontal green line. Now it's showing at 0%, not at 3. Well, what it means is 2-year yields are higher than 10-year. That's bad news for the banks. It causes them to cut the creation of money in the economy, cut back on lending. And what do you have? Well, stock market goes down. You see these inversions. Well, what happens after the inversions is you get what's called a bull steepener, where interest rates go down, bond prices go up. That's what Hartnett's referring to. He said, look, it's bad news. And at his line in the sand is, when do we get to 3%? Well, we'll know sooner than later because we're seeing a rally in bond prices. Again, our CTA Momentum Time Pro picked that up. We'll show you an update on that on Sunday. But there you see it. When we get that rally, it's all over. And he also says sentiment indicators are no longer supportive of further gains in risk assets. He says his custom bull and bear signal surged from 3.8 from 2.7 just of last week, and its biggest jump since February 2012. He said a reading below 2 is considered to be a contrarian buy signal, suggesting that everybody's piling into the stock market, and this comes at a time when inflation is now coming down. People are starting to realize it, and that gets them excited that maybe, just maybe, we'll get to a mythical soft landing. But keep in mind, we've never achieved one, never in history, not once. Got close, but doesn't happen ever. As University of Michigan inflation expectations have outright collapsed in December, and here we can see that looking ahead, they fell to 3.1% in the preliminary December data after soaring to 4.5% in November. You may recall we made a case 2 weeks ago that that was going to be reversed. That was an outright anomaly, and sure enough, it was, because inflation expectations follow U.S. regular all formations gas price. That's shown in red against the University of Michigan inflation expectation. Now you'll note here it's shown up because the government data, when we pull it from the Fred database, does not look at the preliminary data. So preliminary data indeed coming down to match gas prices, and we know that gas prices are likely to head even further lower because West Texas Intermediate, looking at this headline, extends losses to 5-month low. Look at this, gasoline up 5.42 million barrels last week. Distillates, this goes into jet fuel, up 1.27 million barrels. You want to talk about demand going away? Well, you can see it right there in the data, but that doesn't mean consumers don't get optimistic, because they do. Consumer sentiment soared 13% in December, erasing all declines from previous 4 months, primarily on the basis of improvements in the expected trajectory of inflation. So what happens is consumers start to believe that if inflation goes down, that their pay holds up. The part they miss is when we get job losses. That's the issue they miss. The headline jumped from 61.3 to 69.4, with current conditions spiking to 68.8 76.3 to 74, and expectations jumping from 56.8 to 66. Across the board, consumers are more optimistic, and sure enough, that maps out as we see declines in inflation lead to optimism in the consumer space. You see here consumer sentiment shown in blue against the consumer price index, and even admired in a financial crisis or a recession, consumers still get optimistic even though the economy is in terrible shape. But how about President Joe Biden says the job numbers should deter more Fed rate hikes, as he sounds a bit optimistic here, but I'm going to tell you, it's a premature celebration. So many people believe the presidents do not control the economy. They don't have some magic levers in the White House that they can adjust and say, look, we can dial this in. It's all about hope for them because they have no control. This is all up to the Fed. They've inverted the yield curves. They've inverted the money curves. They've caused the banks to cut their lending back. And all he can do now is hope. And I'm telling you, I think this is premature. President Joe Biden said Friday's jobs report shows the labor market remains resilient as inflation continues to ease, an economic, quote, sweet spot that he said shouldn't prompt the Federal Reserve to raise rates further. So what he's trying to do is say, look, Fed, you need to stop this. I got an election coming up. If you send the economy into recession, the odds of me getting reelected go way down, and usually somewhere close to zero. So you got to stop the rate hikes. The problem is he has no control. What he really needs the Fed to do is cut, and cut massively, because President, I think it's too late. The comments are marked as a rare example of Biden weighing in on the central bank policy making. They came as the president gears up for a re-election campaign that will be decided in his part on the stewardship of the U.S. economy, which voters have rated poorly. And here you can see the real issue. Here we got the corrected chart, this of total compensation, showing average hourly earnings multiplied by average weekly hours of production of non-supervisory employees. That is in red. That is headed lower. That is a problem. It's telling us inflation is indeed going down. The issue here, Mr. President, is we need rate cuts. We need them in a big way. We need them now. And frankly, it's just too late. The problem, my friends, is presidents don't control the economy. They're victims of the people that are in office that create those policies, such as the Federal Reserve. And this does not look good. So he needs some hope here in a big way. If he wants to get reelected based on the economy alone, well, he needs that soft landing to stick, and stick quick. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.